Nobody knows what's going on in the stock market right now. I am going to pull different stories and show you guys the complete 360s that everybody is doing because they don't understand what's going on. I'm not saying that I know what's going on. The S&P could end up at 4,500 tomorrow. The S&P could end up at 2,500 tomorrow. I'm not here to predict that. But I think it's interesting while we listen to all of these people, Ray Dalio, Jeremy Gundlach, Cathie Wood, Jim Cramer, all of these people that are so certain on what's going to happen, they're kind of changing their tune as we're running down this road of inflation and a high interest rate environment. So let's start with Jim Cramer, my old buddy, old pal. So he thinks that the mid-June low was the bottom of the stock market. Now, I will give him credit. He has been consistent with this, although he did say that February was the previous low, but that's okay. We're just going to ignore that. He has said that mid-June is that low, and the SPY was at 362. So I just put that in there for 362. He said Monday that he believes stock market will hold its mid-June lows, even though we've had a year of terrible, terrible selling. Now, I do give him credit for this. I'm not a big fan of his, as everybody knows, but I do give him credit for staying consistent with what he believes. I do not agree with his thesis. I do not agree with a lot of his theses on very different companies, but I do give him credit for staying consistent in a way that I do not see is correct. Cramer also gives a nod to the bear arguments that government's environmental agendas are not very market friendly. He's talking about a couple of these bills that were passed, and more layoffs are coming in corporate America. Techs are still way overvalued, which is funny because he was the one saying that you could buy some of these tech stocks and they were going to go to the moon just a few months ago. But now we're seeing that for some reason they're overvalued. So that's Jim Cramer. Another one that I was very surprised on, Cathie Wood got in the mix here. Cathie Wood kind of talks out of both sides of her mouth. She comes in saying that you can buy Tesla, Roku, and I think the other one is Shopify or Spotify, some kind of IFI. I'll just put -IFI because every IFI is going to the moon. And she says that you can buy these and they're going to go up over the next decade. It's an absolute certainty. But at the same point, she's coming in here and saying that we are facing deflation risks with what the Federal Reserve is doing. And that is exactly what Elon Musk is saying as well. So deflation, I highlighted it here for in case you don't know. General decline in prices, goods and services, typically associated with contraction in money supply available. So what they're saying is because we're raising interest rates and because we're doing quantitative tightening now, they are thinking that we're going to experience some type of deflation after a couple of months of raging inflation. I think that there's probably a better argument for stagflation, meaning that we're going to continue to see inflation with wage growth not doing anything, but that's a different story for a different day. Periods of negative growth, stagnant economic growth as well. So Elon said a major rate hike will cause deflation. If history has any guide, we will not make it past the next recession. If this is sounding doomsday, it might be. The Fed's projected that these rates haven't been seen since 2008, and here she is saying that you need to invest in companies like Roku and Zoom and Block and DraftKings, or we could have Jeffrey Gundlach. I'm going to go to him next. He's the bond guy. He's made billions of dollars off of bonds. He says avoid the stock market and just go to treasury bonds, and you'll do well in that capacity. So let's go to Gundlach. He says that the Fed should slow down the rates because it's pushing the economy into a recession. I did this story on the morning show, and he thinks that they should have done more earlier. Basically, they're late to the party. They're late to the party, and they're trying to catch up. I do tend to agree with this. Remember, just in early 2021, they were saying that inflation was transitory. Sorry. It's not transitory. It was incredibly obvious that it wasn't transitory, and there were two people out there saying it wasn't transitory. It was Jeffrey Gundlach and Mohamed El-Erian. Everybody else was on the boat that inflation was going to be transitory. The monetary policy has legs are long and variable. We have been tightening now for a while, and the impact of these tightenings is going to accumulate into a recession. I do think the Fed should be slowing down these rates sometime soon. Not only are they slowing down, but they're doing that QT. Here's the fear that I have. They are going to slow down rates, and personally, I think we're in a recession. 2 quarters of contracting GDP. We are in that. You can change the definition whatever you want. I think that we are in that. I don't want to necessarily give so much credit to the labor market like everybody is doing. But if we get that contraction, we're in a recession, say we're declining, we get a little bit of a rebound, and then we hit a double dip recession. That is what I do not want to happen. That is what my fear is if they do go a little bit easy on rates. I do think the unemployment rate is going up, and I do think we are headed towards a recession. I think the Fed should have pasted this differently. Bank of America, look at this. S&P 500 still hasn't bottomed despite the 7% plunge over the last 3 weeks. The benchmark hasn't reached its full capitulation. Now look at this. I'm going to blow this up for you. And they have 10 criteria here that they need to see markets bottom. That's what they call it. And the last time that you had all 10 was right in here. That was 2009. And before that, look at this. 1990, you had 9. 2002, you had 9. 2020, you had 9. Right now, based on them, we have 4. We only have 4. So to me, if these are right and everything is, and their 10 checklist is as good as they say it is, we have a long way to go. So this fall in the market that we've had still has a long way to go. Now, let's go to somebody else. Interactive Brokers. Now take this one with what it is. The CEO of Interactive Brokers, he's in the business of getting people to his platform, getting people to buy stocks, getting people to do options, getting the cost higher and higher, generate as much income as they can off of traders. If he's out there saying the S&P 500 likely to bottom around 3,300, we still have some room to go, but remember, he's cheerleading the market. He needs to say this because he needs clients to stay. They have seen cash balances climb to record highs. He does anticipate more pain to come, coming down to that 3,300 number that he said. They have taken short positions in futures, written call options against the stocks, so people are not going along from everything that they're seeing over at Interactive Brokers. Ray Dalio, he was talking over earlier this week. He says that stocks, bonds have further to fall, and he sees a recession coming in 2023 or 2024. The U.S. is likely to slide into a recession in one of those years. What else do we have here? The problem that Dalio sees, the Fed is no longer monetizing its debt. So this is the situation that Dalio is worried about, and is very logical, and I haven't heard anybody talk about it. They're monetizing their debt issued by the federal government. In September, the Fed is planning to double the pace of Treasury and mortgage bond roll-off of the balance sheet. They're trying to shrink that $13 trillion balance sheet. Who is going to buy those bonds? That's the big question. Who's going to buy those bonds? Bonds are going up in the short term, but over the long term, what's going to happen? The Chinese do not want to buy them because they're not getting the same return that they were getting. So after 40 years of these positive bonds, now we're getting into this negative real return on bonds. Who is exactly going to buy them? So why did I tell you all this? Why did I kind of I tried to look at different angles. And you know what I found? And I was just telling Sam, it's very hard for me to do this video the way that I wanted to, because even people like Cathie Wood and Jim Cramer are kind of saying, hey, it's going to get worse out there. We're starting to get to that total consensus. One more thing that I wanted to show. This is the ARK inflow outflow over the past month. And ARKK is Cathie Wood's flagship fund. It's the innovation fund. You can see we still do have a lot of inflows coming in here. When we start seeing consistent red, consistent people getting out of the ARK ETF, I think that's when we are going to start saying, hey, the more novice retail investor has left the market. When we start seeing Apple start pulling back and truly pulling back beyond lower than that 130 number, I think that's when you're going to start to say, hey, maybe there's something wrong in this market. Tesla, when we start seeing Tesla pull back, and it will with ARK, it's going to do the same thing. That is when I think that we are going to truly see some type of new correction in the market going beyond those lows that we saw in June and quite possibly going below those lows that we saw in COVID times. My name is Mo. I'm a value investor. I like looking at these different things just to understand. It's not lock and key, but it does give me a general understanding of where stocks are going to go. Remember, I want to buy stocks lower, and I want to buy stocks based on really good, solid foundations of cash flow, growing revenue, growing income. And that is exactly, we need pullbacks in markets to satisfy the prices that I want to pay for different stocks. To learn more about my process and the way that I approach things, you need to go and watch this video right here. It will help you get through these tough times that are coming ahead. I'll catch you on the flip side.
The recent 12-year bull market has had very, very few interruptions. The biggest one was the pandemic.